My name is Jake. Welcome to the channel. If you clicked on this video, you're probably interested in learning about dividend investing or dividend growth investing. I was as well when I first started. When I first started in learning about dividend growth investing, the first thing that I did is I went to Google and I searched, what is dividend growth investing? What is dividend investing? Because as a kid, I always learned that if you want to retire or you want to retire early, you want to have a good retirement, you have to have dividends and you're going to live off dividends. And that always stuck with me. But as the majority of you here watching the video in school, we don't really learn the fundamentals around how that actually works. We're taught to get a job, go to work every single day, and live our lives. And that's kind of, as time goes on, we'll kind of figure it out on the way. So just like you, I started researching about dividend growth investing and trying to educate myself on how I could improve my lifestyle through growing additional cash flow, what I talk about on the channel, or passive income. And I share everything that I'm doing in terms of, what is working, what is not working with this dividend growth strategy. And as the channel has grown, I've been getting a lot of questions, or a lot of people have said, okay, well, you're mimicking other portfolios, other channels, and I will say very transparently, I was 100% inspired by other YouTubers to not only invest in a dividend growth strategy, but also to start a YouTube channel. A few in particular. When I first started learning and researching about dividend growth investing, like you may be doing right now, was I first came across a channel called PPC Ian. Ian is remarkable when it comes to getting into the nitty-gritty of what is dividend growth investing, how does it look like, and really getting into the fundamentals. Another YouTuber that really inspired me, probably inspired me the most to start this channel, was Joseph Carlson. And I've gotten a lot of questions over the last couple of weeks as the channel has grown and gained a larger audience that there's a lot of similarities between my channel and his channel. And I will say absolutely. My channel was 100% influenced and inspired by Joseph Carlson. So if you're an avid Joseph Carlson watcher or subscriber, I think you're going to see a lot of similarities. However, what I've tried to do with my own channel is really focus on, okay, what was important to me specifically when I was first learning about dividend growth investing. And I also, like Joseph Carlson, I invest with M1 Finance. I absolutely love the platform. I share here on YouTube exactly what I'm invested in. The holdings that you're seeing and the amounts here that you're seeing on the screen, this is all real. This is my actual money. I have a 9-to-5 job. I also have other side hustles, right? I have a rental property, but everything here is real. And this is a lot of money to me. And I'm very transparent. I want, really the goal of my channel, when I kind of look at this from a 360-degree view, is I want to help other new investors that were similar to me when they were first learning about dividend growth investing. So in today's video, I want to talk about what it means to be an aggressive or a moderate or a conservative investor. Have you ever caught yourself in a conversation, you're talking to somebody, you're maybe talking about Tesla, and you're hearing the other person that you're talking with say, yeah, I'm investing in a Tesla, I'm investing in a Bitcoin, it's going great. And you're thinking to yourself, oh, no, I don't invest into that. I'm a conservative investor. Or on the flip side, maybe you're talking to somebody about, how they invest into bonds and, they're looking to go into that direction. And you're thinking to yourself, oh, no, I don't invest into bonds. I'm an aggressive investor. So I want to talk about what it means to be an aggressive investor, a moderate investor, and a conservative investor. And what I want to first start out with looking at is I want to go into M1 Finance Expert Pies. If you're unfamiliar with this is kind of like the robo-advisor part of the M1 Finance platform, where they're using expert pies that they put together to suggest investing strategies or different portfolio mixes. So the way that it's set up in all the way from the one end of the spectrum to the other, from ultra conservative to ultra aggressive. Okay. And so What does it mean to be ultra conservative? So if we dive into this pie that they have here, and we can see, okay, what is the historical performance, and really looking to see, okay, what is this portfolio made of? And this ultra conservative portfolio is made up of over 80% in bonds. Bonds, in this case, treasury bonds, so 1 to 3 year. I mean, this is a very conservative portfolio. This is really for those that are not looking to see the ups and downs, the volatility in the market. This is a much more conservative portfolio. Now let's look on the other end of the spectrum at the ultra conservative, the ultra aggressive. You can see here the respective performance. If you would have invested $100 over the last 5 years, this would have been your return in this portfolio mix. You can see here it's filled with some international holdings, the S&P 500, small cap, mid cap, but also a very, very small portion in 1% into bonds. So this is kind of, when you're a new investor and you're looking at this and you're thinking, okay, well, what am I? Am I an aggressive investor? Am I moderate? Am I ultra conservative? What am I? And so I think in order to really assess that, you have to understand risk. What is the risk associated with investing in at all, really? So a few things that I want to take a look at, right? There was an article written by the Motley Fool that Americans are saving more, they're making more money for retirement, but still they risk falling short. So what could that mean? If we're making more money, you would think conventional wisdom would say, okay, well, we should be better set up for retirement. But that's actually not the case. If you follow CNBC or you've watched any interview with Warren Buffett, Bill Gates, Charlie Munger, Berkshire Hathaway, you probably have seen an interview with Becky Quick. Becky Quick is the CNBC anchor, and she has years and years of experience. Also, she's sitting in the room with these really high-profile investors in Warren Buffett and such. But what she's saying is that she's 100% in equities. And she's not in her 20s, right? She's not nearing retirement tomorrow. But what she's saying is you're never going to make enough money if you have 40% of your money in bonds. Okay, so this is really, really interesting. Okay, now if we take a look at a study or a survey that Fidelity came out with, where they surveyed over 3,000 respondents, and what they found was that yes, Americans in particular, it's just focusing on the US market, Americans are getting better with their money, but they're still falling short, right? That over, around 30%, 29% believe that they are not at all ready or on target at all for retirement, where also that 54% believe that they are on target to cover all essential expenses. That's about half. That means if you look at this from the reverse side, half of the people that they surveyed do not feel like they're going to be able to cover all of their expenses. And the part that I thought was the most interesting was it broke down the percentages by age group. Looking at this from a millennial perspective, a Gen X perspective, and a boomer perspective. And the thing that I want to look at is, these three things here on the bottom. I know how much I need to be saving to meet my expenses in retirement. Less than half of millennials feel like they're comfortable with their retirement savings. This is downright frightening. This is scary. Even though the highlight of this survey is we're making progress, but still more than half of millennials do not know what they need to do or how much they need to save for retirement. However, if you go look at the next thing that was surveyed, they believe 70% of millennials believe they will have enough money in retirement to maintain the lifestyle that they want. Okay, that's interesting. Maybe a little bit overconfident considering what we just looked at. And also lastly, retirement planning is too complicated to do on my own. And this is pretty consistent and consistent across all age groups. About 40% believe that it's too complicated to do it on their own. So this is part of the video where when we're talking about risk and we're talking about different investment approaches, whether it be conservative, moderate, or aggressive, in this scenario, when we look back at this article that Americans are saving more money for retirement, but still falling short, because, those that just experienced the financial crisis, maybe they're more risk averse and they're investing more conservatively. And, I'm going to say it, that if you're investing too conservatively, there's actually risk associated with that. And I know that there's going to be one person watching the video, when they hear me say that investing too conservatively is actually is a risky thing, they're likely going to respond like this.
You serious?
All right. So what are the risks of different investment types? There's 3 different asset types that you can invest in. And the first being cash. So this could be your short-term investments, whether they be treasury bonds, certificates of deposits, cash accounts, and so forth. The average return over time on these type of investments, on this asset class, is about 3.5%. But if you factor in inflation, you're just getting over 0.5 percentage point. So the inflation piece is so important that often gets overlooked when we think, oh, okay, I'm going to put my money for a year in a certificate of deposit. I'm going to get 1.7% or 2.2%. You have to factor in inflation. Okay. The next asset type would be your bonds or bond funds. The average return over time for US bonds would have been 5.5 years before inflation. So after inflation, just 2.5%. The third asset class is going to be your stocks. And here, the average return over time for US stocks is averaged right around 10% before inflation, and after inflation, right around 7%. So when you're doing research on an investment class, whether it be bonds, cash investments, or stocks, I think it's important that you understand the underlying risk associated with that. And really, it starts with you looking at, okay, what is your investing time horizon? All right, so when I'm looking at this from my when I'm doing research on companies, whether it be individual companies or ETFs, for example, if you follow my channel, you know that I'm a big fan of Vanguard ETFs and index funds. I invest into those in my my Roth IRA, my Roth 401k, and my HSA. I shared a little bit about that in my last video, as well as investing in individual companies. But when you're doing research and you're looking at, okay, what is the potential risk of this investment? I think it's important to understand that. So if you were to just invest into an ETF, it's important that you understand, okay, what is that underlying risk? Okay. And particularly, okay, understanding what is my time horizon. If you're looking to access the cash or the capital in your account within the next 3 years, you probably should be investing more conservatively. What that means, you're having a higher exposure to treasury bonds or holding that in a cash reserve versus investing into corporate bonds, more aggressive bonds, or aggressive stocks. Okay. Another one would be, okay, conservative to moderate would be somebody that is has an investment time frame of 4 to 10 years. Now, the cool thing here is the audience or the demographic watching my videos here on YouTube, the majority are in your 20s and 30s. However, there are a few of you out there that are in your 50s. And this is something that you can look at, right? If you're nearing retirement in the next 10 years and understanding, okay, well, how does this apply to me? Because this will definitely apply differently if you're in your 50s or if you're in your 20s. Okay. Moderate risk would be, for example, you're looking to invest for more than 5 years. That's kind of your time horizon. Well, 5 years, meaning that's when you're going to access the capital within the portfolio, or that's typically what it's looking at here. It's looking at liquidating the companies and what is the share price actually going to be. What is the volatility going to be like if you have that time frame? On the channel, I talk more about growing passive income through dividend investing, and you're going to live off the dividends. So this is a little bit different. So it's important that you understand that. Moderate to aggressive would be you're looking at this over the last, looking at a time horizon of 10 years or longer. And aggressive could be looking at this for 10 years or longer. In some cases, you're looking at this maybe 20 or 30 years. Okay. So one thing that I do want to highlight is this level of risk is not just looking at, okay, I'm going to invest into Tesla or Bitcoin or McDonald's or Coca-Cola. It's not looking at that. It's looking at the asset class, right? And when we look at the risk versus the return, this is what we're talking about. You're going to have the lowest amount of risk, but also the lowest amount of return if you're going with, for example, treasuries or certificate of deposits, something that is very, very conservative, where you're not really risking the actual overall portfolio value. And the next one you can take a look at here is, corporate grade bonds, investment grade corporate bonds. They're going to have a higher return, but also you're going to have a little bit more risk. Then going further through, looking at this from a riskier perspective but a higher return, you're going to have blue chips. These are going to be your Johnson & Johnson's, your Procter & Gamble's, your McDonald's, these more established, larger companies. And then up from there, you're going to have mid cap. These are going to be your smaller companies. These are going to be, your ServiceNow, your Adobe's, those companies that are growing, but they're not considered blue chip. And then lastly, you're going to have your small cap equities. Here, you're going to have the highest fluctuations, the most volatility, but also the most potential for the highest returns. Okay, so it's important that you understand, okay, where are you at? I personally find my sweet spot is in between blue chip and mid cap. That's really where I personally like to invest, where I'm in my 30s. I still have time for my investments to grow. That's really my sweet spot. All right, so if we were to look at the historical returns of a conservative portfolio, a moderate portfolio, and an aggressive portfolio, what is that going to look like? I think we can all agree that in the short term, it's, if you're investing for just the short term, you're betting, you're speculating. And I think Jack Bogle, the founder of Vanguard, has a really good way of putting that.
In the short term, the stock market is a casino. That's correct. In the long run, it is not a casino. It's a machine for compounding interest and returns, which, as Einstein said, is the greatest miracle in financial history.
So if we go over here back over to Vanguard here, and we take a look at the Vanguard portfolio allocation models, I shared this in my last video, so I just really briefly want to take a look at it. I will, if you're interested in more detailed information on this slide here or this page, you can go check out my last video. But essentially what it is it's looking at, okay, what would have been the historical return based off of your allocation of bonds versus stock. And you can see here, the more exposure you have to bonds, the lower your returns will be, but also the lower volatility with the best year and the worst year. And as you go down and you see, okay, as it focuses more on a growth portfolio mix where you're just investing into stocks, for example, you're going to have the highest annual return, but you're also going to have the most fluctuation, the most volatility. All right, now that we know a little bit more about what it means to be an aggressive, a moderate, or conservative investor, I want to dive back into M1 Finance and walk everybody through a little bit of how I manage my risk or how I manage my portfolio here in M1 Finance. And if you follow my channel, if you subscribe to my channel, you know that I would consider myself an aggressive investor. I am heavily weighted in individual stocks and ETFs that follow the broader market. I don't really invest into bonds. Like, that's not something that I'm looking to do here in the short term. That may change over the years, but as of right now, I'm invested about 98, 99% into individual stocks and stock funds. All right. So I have about 10 plus, well, I hope 10 years, but we'll see how that goes. About 10 years before I reach my goal of early retirement. It's going to take a lot of time. It's more than just investing in individual companies or ETFs and just sitting back and watching it. I also do other things. I have a rental property that I've talked about on the channel a little bit here, but what I'm getting at here is I'm not going to be retiring tomorrow. And If you look at my portfolio, I'm invested into individual companies and also a few ETFs in my overall M1 Finance portfolio. And this portfolio, this is my main portfolio. This is what I'm funding every single week. I have other accounts on my Roth IRA, my Roth 401k, my HSA. That's my Roth and my HSA, they're going through my employer. My HSA, my Roth 401k, but my Roth IRA, I'm only investing $6,000 a year. It is a priority for me, but the majority of my focus is in this portfolio right here, right? And I have just under 100 holdings. I have right around 90 holdings. And I've shared in other videos that I do not recommend this for everyone. This is something that works for me. It's something that I enjoy. I'm kind of a dividend nerd. I love investing into high quality dividend growth companies that have a track record or a history of growing their dividend. And that's just one thing that I look at when I'm investing into companies, is a strong track record of dividend growth. Okay. But there are also cases. In my first video in 2019, I shared 4 things that I learned about dividend growth investing, some of the mistakes that I made, and I was very transparent, right? I've made mistakes in the portfolio, and I'm continually learning, and it is a process. But one of the mistakes that I made is I fell trapped to the yield trap, where I invested into companies that had a very high starting yield, but were unable to sustain that yield and actually ultimately ended up cutting their dividend. If you're interested in a really detailed explanation of that, you can check out my video there. I'll leave a link in the top right. But what I want to share with everybody is, I've said repeatedly on the channel, I am a buy and hold investor. However, there are very few cases when I will sell the stock. And this last week, I sold 2 companies. I sold 2 stocks. And I'm going to share in just a second why I did that. But the 2 that I sold was the first, the Kraft Heinz company, and DHC. DHC went through a rename. They're a REIT, a real estate REIT. And I sold both of these companies because they cut their dividend. So, and among other reasons. But the main reason why I cut these holdings is because they cut their dividend. And I'm invested into this strategy so that I can grow my income over time, so that the dividends are growing. And when a company cuts their dividend, this is a massive red flag for me. And I take it seriously. It's not always the case where I sell the stock right away. As you can see in this scenario, these companies lowered their dividend or reduced their dividend months ago. But I've come to the realization that once a company cuts their dividend, that is for me a time when I will sell out of the company. And I follow really the Sure Dividend 8 rules of dividend investing. Sure Dividend has a massive amount of information around dividend growth investing. And one of their 8 rules of dividend investing is the survival of the fittest. And I will share this link in the description below if you're interested in this. I got a massive amount of value from this article here. So the survival of the fittest. When the facts change, I change my mind. What do you do, sir? I love this quote. And if a company reduces or cuts its dividend, that means that it's paying you less over time. That means you're making less money. And that is also impacting the power, the compounding effect of your dividends over time. So when a company does cut its dividend, this is a time when I eliminate it or I take it out of my portfolio. And that is why I did that with the 2 holdings here with Kraft Heinz and DHC. All right. And with that, I was able to purchase other companies. Right? And the goal here is, it's different than other portfolios like Robinhood or TD Ameritrade, where what I'm trying to do is I'm trying to leverage the dividends of every single company in here to then build and create that compounding effect and purchase other shares of other companies. For example, when Verizon or DRI, the Olive Garden, comes or AT&T, they pay out a dividend, I want to use this money to then also purchase other shares. All right. And that's really what has been the goal since the beginning. And this scenario right here, the very first time that I saw this, I mentioned in the beginning of the video, was from Joseph Carlson. When I saw this on Joseph Carlson's show, it really opened my eyes. And it was just like that light bulb effect that, wow, this is so powerful, because before then I was using Robinhood. And back in May, I was investing into whole shares. I was transferring money over every single week from my bank account to my Robinhood account. And I was looking and following, okay, which companies are on a discount, and doing it all manually. And it was taking hours and hours and hours a week managing my portfolio that way, where I had to make individual purchases and execute on individual trades. Yes, they were free because Robinhood, it doesn't charge a commission like many other brokerages today, but it was a lot more time intensive. And with that, there was a lot more emotion involved with that, where I was manually having to go in there and click the buy button, the purchase button, and manually put in a limit amount of how much I was going to purchase the amount for. It really made my emotions kind of just go in overdrive. And by switching to M1 Finance, I've really automated everything. And I have my transfer set up every single week where I'm transferring money into my main portfolio, which is where I'm transferring over $300 a week into my cash flow portfolio. That's where I hold the majority of my US stocks, my qualified dividends. And the other portfolio that I have here is my real estate portfolio. And in my real estate portfolio, I'm transferring over about $100 a week. So about not quite $1,800 a month. And these $1,800, I mean, that's a lot of money for me. I'm having to work 9 to 5. I'm hustling. I'm also, I have my side hustles with my rental income that's cash flowing, right? That's paying me every single month, that I'm using to also invest into my portfolio here that I share with you, everybody here on YouTube. So that is how I have it set up. And like I said, I mean, I haven't been invested with M1 Finance for all that long. As I mentioned in the beginning of the video, I was really inspired by other YouTubers to start a YouTube channel, to start investing into this strategy. And I can so thankfully say that I'm so grateful that I came across these other YouTubers, these YouTube channels that have helped inspire me to also share with everyone else kind of what has worked for me, and add my own original opinions and experience to how I started a dividend growth portfolio here with M1 Finance, with all of you here on YouTube. If you're new to the channel, I'd invite you to subscribe. I share videos like this every single week. I really am focusing on newer or beginner investors. If that's you, hit the like button, subscribe to the channel, and I'll catch everybody in the next video.